Hello, everyone, and welcome to episode 8 of Does It Make Sense? This is the show where we break down businesses, startup strategy, the psychology of money, operational excellence, and everything in between. And at the end of every episode, we will answer the one question every entrepreneur, investor, and decision maker eventually has to ask: does it make sense? Today's episode is titled The Serious Money Paradox. Now, we all love the speed and convenience of fintech apps, but when your savings become serious money, is your favorite app still the safest place to keep it, or does old school banking still have the upper hand? The question came from an unexpected place. My aunt looked at me one day and said, anyone who keeps their money in phone apps doesn't have serious money. At first, I laughed it off, but then I started to wonder, is she simply stuck in the past, or does she understand something about wealth that my generation has forgotten? Let's find out. So I was speaking to an elderly aunt of mine recently, and the conversation drifted to how we manage our lives in this day and age. I happened to mention to her that I don't use traditional commercial banks anymore, and that all my money is split across digital fintech apps like OPay, MoneyPoint, Kuda, RiseVest, Bamboo, etc. She looked at me, shook her head, and said something that really stuck with me. She said, anyone who keeps their money in those phone apps doesn't have serious money. And anyone who has real serious wealth will keep it with a proper commercial bank. Now, at first, I wanted to laugh it off, but it made me think, is she just stuck in the past? Or does her generation know something about Nigerian financial reality that my generation is completely blind to? Welcome back to Does It Make Sense? Today, we are breaking down the ultimate banking battle: the digital tech apps versus the traditional marble floor commercial banks. Because when you are holding decent savings in Nigeria today, deciding where that money sits isn't just about convenience, it's about survival. Let's look at why my aunt's generation think the way they do. It comes down to a concept that I always talk about, which is salience. Basically, human beings naturally default to what is visible and prominent in front of them. To an older Nigerian, a bank isn't an icon on a screen. A bank is a massive multi-story concrete building with armed security, air conditioning, and a physical manager you can look in the eye. Her generation lived through the banking crashes of the late 90s and early 2000s, where financial houses vanished with people's life savings overnight. To her, if a crisis hits, at least you can drive to a physical branch, lock the gate, and demand your money. With a fintech app, if the screen goes blank, who do you hold? Who do you drag to the police station? But let's look at the actual reality on the ground today. Has the safety game changed, or is my aunt right? On paper, the protection gap between your app and a traditional bank has actually closed. In Nigeria, the NDIC, that's the Nigeria Deposit Insurance Corporation, is the government body that guarantees your deposits if a bank goes under. Recently, the NDIC raised its maximum insurance coverage limit to 5 million naira. If a giant traditional bank like UBA or Access Bank collapses tomorrow, The government legally guarantees to pay you up to 5 million naira. And guess what? For digital wallets like OPay or MoneyPoint, the NDIC uses what they call pass-through insurance. Your money isn't actually sitting inside the app company's office. It's kept in a pooled account at a major commercial bank. Because of this, the government also insures individual app users for that exact same amount, up to 5 million naira. So if you have 3 million naira in savings, your money is technically just as safe from a total banking collapse inside a licensed fintech as it is in a tier 1 traditional bank. But this is where my aunt's argument actually starts to carry weight. What happens when your money becomes serious money? What happens when your savings hit 10 million naira, 15 million naira, 50 million naira, or 100 million naira? The moment your savings cross that 5 million naira government insurance threshold, you run into two massive concepts: systemic risk versus operational risk. Traditional banks suffer heavily from operational risk. We all know the script. The app crashes on a Friday night, the network token fails, or you stand in a grueling queue for 3 hours just to resolve a wrong debit. Fintechs completely solved this. They won our hearts because their technology is fast, their uptime is near perfect, and their transfers drop in seconds. But what fintechs gained in operational speed, they lack in regulatory and systemic risk. Fintech companies are heavily dependent on the immediate shifting policies of the Central Bank of Nigeria. We have seen instances where the CBN suddenly freezes fintech account creations or changes compliance rules overnight. If a commercial bank gets into regulatory trouble, the CBN handles it quietly behind the scenes, because crashing a major bank would ruin the entire economy. But if a fintech app gets flagged, the regulator can pull the plug or freeze operations instantly. If your entire life savings are behind that digital screen, when a regulatory freeze hits, you are stuck. Now, there's another brilliant concept from philosophy and economics called the Lindy effect. The Lindy effect states that the future life expectancy of an institution or a technology is proportional to its current age. If a business has already survived for 70 years, for example, it has a much higher chance of surviving another 70 years because it has already figured out how to outlive inflation, currency changes, economic depressions, coups, etc. Traditional institutions have survived every single storm that Nigeria has thrown at them. Most fintech companies are less than 10 years old. They haven't truly been tested by a prolonged multi-year economic depression. So how do we make sense of this? The answer isn't that my aunt is completely right and that digital apps are a scam. The answer is that we are using these platforms the wrong way. A smart financial strategy in Nigeria today requires a clear split. Fintech for velocity, traditional institutions for sovereignty. If you are running a business or making daily transactions, it makes zero sense to rely on the slow, clunky apps of traditional commercial banks. The speed and zero downtime of digital platforms keep your economic engine moving. They are built for the daily hustle. But when it comes to storing large blocks of wealth, you cannot treat a digital wallet like a fortress. For serious savings, you need a multi-layered approach. You can use digital wealth platforms like RiseVest or PiggyVest to convert your falling naira into hard dollar assets, protecting your money from the melting effects of hyperinflation. And then you can keep a foundational anchor in a tier 1 commercial bank. Not because their customer service is great, but because they hold the institutional weight required for the long haul. When you need a massive business loan or an international bank statement for a visa or a major credit facility, most of the time, a digital wallet simply cannot help you. So I want to put this to you guys. Are you team A? Do you trust the fintech apps completely and keep your primary savings entirely digital because traditional banks are too stressful? Or are you team B? Do you agree with my aunt that real serious money belongs under a traditional brick and mortar roof? Let me know what you think in the comments, because at the end of the day, we have to stop confusing the speed of an app with the stability of an institution. Convenience is great when you are spending money, but history shows that survival is what matters when you are protecting it. My aunt might not be familiar with the latest trends in the fintech space, but she surely understands how Nigeria works. The question is, we? Until next time, look after your cash and keep your feet on the ground.